Thanks for joining us for this PCX webinar update. I'm Adam Myers. For those of you who don't know me, I lead the distribution team here at Pengana. And I thought we'd try something a little bit different today and have a conversation instead of the typical presentation style webinar, because I'm pretty sure we've all sat through enough of those. I have some questions that I've prepared, but it would be great to have a broader conversation. So if you have any questions, please enter them in the Q&A box and I will try and bring them into the conversation. Joining me today is Rebecca Jakes, who's the Head of Wealth Management Investment Solutions at Mercer, Nehemiah Richardson, who's the CEO of Pengana Private Credit, and Adam Rappaport, who is the Portfolio Manager. If you joined early, you would have noticed the holding slide that basically was talking through some of the achievements that the Pengana Private Credit Trust has basically set out what we achieved when we brought the trust to the ASX a little over a year ago. Now, we'll talk more about those during the course of the conversation. But first, Nehemiah, I thought it would be useful for you to do a bit of scene setting and explain our objectives when PCX was first established.
Yeah. Okay. Thank you very much for that, Adam. And I thank all of you today for taking time out to participate in our webinar. I guess just to start to say, how pleased we are to be here doing this, with you all and really discussing, PCX and the performance that we've actually been able to deliver over the last 12 months. So with that, just to recap PCX and its reason for being, as I think it's sort of really useful context when we start to talk about, objectives and performance over the course of the last 12 months. So as a bit of background context, when we set up the credit business and really for this vehicle, it really was to try to address a number of different challenges that we thought from a Pengana perspective were faced by Australian investors. And I think there's really three sort of key thematics, and some of you may have heard me talk about this before. The first is the demographics, and what do we mean by that? Well, we mean, if you look around the developed world, what you see is aging populations with, growing number of people that are getting close to or at retirement. And so reliable income and capital preservation becomes of primary importance for many of those people. Secondly, when you then look from an Australian perspective at what are the investment options that are available that provide income and stability. So for example, Australian government bonds, Aussie bank bonds, Aussie private credit, hybrids, which I know is a disappearing industry, but still available today. And then there's a proliferation of other Australian income products that may be fit for purpose, but I think they're at a macro level correlated, meaning they're all impacted by Aussie macro. So whether it's state of the property market, state of interest rates, general business conditions, unemployment, et cetera, all the same sort of macro drivers and can many times move on a correlated basis. So then the third dynamic is the increasing risk and volatility, both in frequency and amplitude that we see in both traded equity and fixed income markets, which creates an additional challenge for investors who want or need just to have reliable income with that capital stability to manage their longevity risk. So I think with that as background, we saw global private credit as a very valuable portfolio construction tool, given that it's had proven ability to add resilience to portfolios. And what does it add? It adds, stable and consistent income, capital stability through its low volatility, and really good portfolio diversification because of its low correlation to traded asset classes. And so with that, adding robustness to investment portfolios. Now, the issue for investors is that historically it's been quite difficult to access the global private credit opportunity and also to do so in a diversified manner. And that is why we set up our business, and that's why we set up PCX to deliver on this by creating a vehicle that does a number of different things. Number one, provides diversification. So we're diversified by geography, the US and Europe, the mature markets in global private credit. We're diversified by manager and strategy. Secondly, we built a portfolio that first and foremost is about capital preservation and resilience. So predominantly senior secured. We're pointed at this structural opportunity, meaning where banks are withdrawing from providing bilateral credit to attractive companies. Thirdly, it's accessible, so you can buy to market, do one trade, and with that, you get a portfolio of over 23 managers and over 3,500 loans. And finally, you can exit at NAV through using our quarterly buyback mechanism. Now, this serves to kind of do a few things. Firstly, it serves to minimize the potential for PCX to trade at a discount to its net asset value, because you have that opportunity to exit at NAV on a quarterly basis. But secondly, it provides, at the end of the day, capital stability because you can do that. Okay, and so we set up the vehicle to do all of those things. And I guess the final thing that I'd leave you with before handing back to Adam is to, I guess, reiterate that we're really proud to have done this and provide this opportunity for investors, and to have delivered, what we promised at the outset this time last year.
He's like one of those proud fathers. Adam, so just making sure that everybody is up to speed before we move on to the more relevant stuff relating to the current opportunity. Please just touch on the actual implementation and what we've ended up with in PCX.
Yeah, sure. Thanks, Adam. So as promised, we've deployed more than 80% of the funds we raised in the first month after the listing, and we were fully deployed within 3 months. We started with investments in 19 funds, and that's now grown to 24 funds. And those investments, as Nimai said, they're diversified across managers, across geographies, and across strategies. We started paying monthly distributions in the first full month after the listing. And although we've only been fully deployed for about 9 months to 30 June, we've always met our minimum target 7% cash yield. We've seen NAV growth of over 1.5%, and we've been through 3 quarterly buyback cycles, which has really demonstrated that the buyback process works as expected. More recently, we declared a substantially larger dividend last month to return some of that NAV growth. And now that the portfolio has reached scale, we'd expect to see ongoing NAV growth and cash yields above our 7% target minimum.
Right, thank you. Beck, bringing you into the conversation now, there has been a lot of press about the local private credit environment. Admittedly, not all is positive, but we are seeing a lot more product coming to market as well. What does global private credit add to investment portfolios, and what is your reason as a portfolio constructor for including it?
Yeah, I'm happy to address. There's quite a few things in there, Adam, but let me touch on. So the first issue is, the Australian private debt industry is still relatively embryonic, right? When you compare it to what we've witnessed globally offshore develop, particularly in North America and Europe. So I think that's one area to think about, in the sense that our market still has a degree of evolution to go. It's also a little bit hampered by its size, in the sense that it tends to be very much focused on just like sort of real estate private debt. So you end up very concentrated in one market. And then there are the issues that have obviously been appearing in the press about some of the liquidity constraints that are emerging as we enter into a more challenging environment. What I would say is that challenging environment will still play out globally as well as locally. And I think, this is where having a global, well-diversified portfolio becomes quite important. But at the same time, you can't just go global for the sake of being global and go, well, I've solved all the issues that I need to. There are a lot of structural innovations taking place, and they're really they're sort of underpinning that sort of rethink of how private debt now aligns with in different investors' liquidity profiles, and then obviously all the different sort of regulatory environments that you take that into account. So for us, it's about, global gives us a much better ability to access the asset class. It gives us a much better and more flexible structures. And it gives you a broader sort of scope to invest across the universe, right? Because we know that private debt is an area of speciality. And we see that in how some of the firms have organised, their offerings, but also just their expertise in house. So that's what global represents to us, is really the ability to, be able to take place not just of all the structural shifts that are going on, but how you are best placed to access the asset class to give you that flexibility to play in the various markets that you want to play in.
I actually realized that a piece of background we didn't give up front, and I should have apologies, is Mercer's role. This is a Pengana product, a Pengana webinar, but we work so closely with Mercer that Rebecca is on the webinar presenting with us. Adam, it's probably worthwhile for you to briefly explain the role that Mercer plays and the value that they add.
Yeah, sure. So, as we all know, Mercer is a major global player in the private credit space. They've been active in this market for more than 20 years, and they've got offices across the globe. So obviously we benefit from their in-depth, on-the-ground knowledge, but our relationship with Mercer also gives us a lot of other things. It gives us unique access to bespoke Mercer funds that we couldn't otherwise invest in. It lets us benefit from Mercer's significant buying power to get material fee discounts from our managers. And we're also able to leverage off their manager rating and selection process to really help us build the right portfolio to deliver on our targets.
Okay. And if we dig a little bit deeper into the rating and selection process, I mean, the universe is massive and it's growing every day. Rebecca, can you just talk through what that process looks like?
Yeah, I mean, look, we're a global research house. That means what we do is we put people on the ground where the offerings are. And we do that for a very specific reason. It's really just so that you're close to the source of the intellect of where it is, and also you can spot problems a lot quicker. We all know the sort of scenario of you fly over to see someone and clearly they put you up in their shiny boardroom and, everything's looking brilliant. But when you're actually just two doors down the road and can pop in at any stage, it starts to change what you see and hear of what's going on. So for us, it's very much about having the right people and the right expertise on the ground. We have about 167 dedicated private market specialists that are looking not just for the uniqueness and points of differentiation of a strategy, but a lot of it is around their track record of actually executing that strategy. Does the structure have an alignment to investors? So, i.e., is it working both for the actual firm, but also the underlying investors? There is a massive focus that we do on what we call the operational due diligence, which is not just the governance side, but also the legal teams, the structuring requirements, because a lot of, private markets comes down to whether the actual unique solution that they've developed in this particular instance and the type of terms and conditions that you can go into. So, you typically hear of vintages, and different sort of offerings. They're all largely similar. They're trying to play in the same sort of space, but each of them can have very different terms and conditions. So it is a key focus of what we focus on. We also like that expertise in being able to manage defaults, right? So it's not just about origination and sourcing the deals, but it's also about how do these firms, what's their history, what's their strength in being able to manage the terms and conditions so that when the market environment does become challenging, they still are able to capture either all or most of the upside that they went into, right? Because we all know that with anything that there can be defaults. And so it's about how good is the firm at being able to structure that so that you don't just be forced out and lose your whole investment. So there's a lot of nuances in it. It's not a sort of exercise of going and ticking through a certain checklist. But there are some key variables that you look for, which is that sort of the structuring, the governance. There's the ability to manage defaults, but then there's the actual embedded expertise of the team and the group in sourcing and origination of those deals.
So just repeating, you said 167 investment professionals involved in identification and due diligence.
Correct. Yes, round the globe.
That scale, very few organizations globally can replicate. So it is a real differentiator.
And Adam, it is also about, you can see that there's three big buckets that I talk about. And so we do have big operational teams that are very well versed in understanding and can get through those, 300-page legal documents. But also that understand how the terms and structurings are changing, right? Which are not always for the better, right? A lot of this development that we're seeing in private debt and the different types of structures that are coming to market, the semi-liquids, the secondary markets that's emerging, all of that means that you need to be on top of the trends, but also making sure that you're not walking away from the advantages that the part of this market used to bring to the table.
And I also think the value of legal due diligence is often overlooked, because making sure that you negotiate the best terms, and are aware of all the pitfalls is critically important, particularly when things don't go your way.
Yeah, absolutely. And unfortunately, it's the very dry area that most people don't like to talk about. But yeah, unfortunately, it's probably more critical. And if you look at the dispersion in returns that we see between really good, managers and really poor managers, it's quite dramatic in the private market space. And a lot of it does come down to the fact that those terms and conditions, are not working in their favors.
Understood. Nehemiah, notwithstanding the news cycle and some of the economic turbulence that we're all aware of that is associated with that, it does still feel as if it's been a pretty favorable environment for private credit. Have there been any temporary tailwinds that may not be repeated, or are there any dark clouds that are looming that our investors should be aware of?
Yeah. So I think it's an interesting question, because it's, the way I think about it, and unfortunately it's pretty boring, but, well, actually to start off, if you look at the current environment, you could say every day, depending on what happens in the news cycle, there's a tailwind or a headwind, right? And so I don't think in something like this, I don't think and because it's not a traded asset class, it's not the sort of thing where I think tailwinds, headwinds kind of really matter on a day-to-day basis, or kind of more slow moving and structural, if you will. And so with that in mind, I think, and you'll see this as a feature in our monthly updates, which I always feel like are pretty boring, because I feel like we find different ways of actually saying the same things, which is there's a few things that you should always consider when looking at private credit in dynamic environments. I think the first is that we are likely to continue, as I said earlier, we're likely to continue to experience volatility and uncertainty in markets and macro environments. And so with that in mind, our portfolio working with Mercer has been constructed so that it's relevant irrespective of environment, right? So we tend not to be too focused on the tailwinds and headwinds, more how we remain relevant and resilient when you look at our overall portfolio. And so with this in mind, there's a few critical elements. The first is, we play where the structural gap exists in the US and Europe, and that gap is only continuing to grow, right? The banking system simply does not have the capacity, right, to kind of meet the investment demands of today or tomorrow, And the regulatory constraints that you see in developed market banking are going to continue for the foreseeable future. So, the borrower demands for private credit, I think, are only going to continue to grow. And so you want to be pointed at where the structural opportunities exist through our managers. Okay. Secondly, it's on the manager selection, right? As Beck just talked a bit about, but those with proven track records of delivering growth and performance, given their strong market position, strong credit management capabilities, abilities to kind of work things out to minimize loss, and the scale to allow for solid performance throughout any environment. So what do I mean by that? So for example, a lot of people, one of the key drivers of private credit is M&A. And for the last couple of years, M&A has been quite anemic, whilst a lot of funds have actually gone into the system. Now, one of the things that's really important is when you look at our managers and their tenure and their scale, their origination capabilities, et cetera, and the size of their funds, well, they've been able to grow their portfolios in this environment where about 80% of the volumes that they generate to continue to grow their businesses is from deal flow that comes from their existing portfolios, which is the evidence of the market scale they have. And I only mention that because that goes to an example of the importance of having long tenured managers with really good market positions. And then finally, there's diversification. So our portfolio has been constructed to minimize concentrations, to minimize idiosyncratic risks, right? And that's why we vary it by geography, strategy, and manager, whilst at the same time we have flexibility to be opportunistic in dynamic environments, right? So an all-weather portfolio. So all that said, whilst we look at near, medium, and long-term trends, our focus is really on making sure that our portfolio construction, manager selection, and diversity can provide resilience throughout any environment, good or bad. And that helps us also to keep across all the trends and scenarios, as they play out.
Great. That was comprehensive. I'm going to bring in an audience question that has actually been asked in a few different ways already. Adam, what are your expectations for the portfolio and the returns for the coming year? Have these changed?
So I'd say the short answer is no. The slightly longer answer is our expectations really haven't changed. We're really just forecasting more of the same. So recently, we've started to see the NAV growth that we always foreshadowed. And in July, we declared a larger dividend to return some of that accumulation to our investors. So if we look forward to the coming years, now that we're at scale, we expect the NAV to continue to grow. And on the back of that, we'll keep looking for opportunities to keep upsizing our distributions, to keep pushing our NAV yield up. But really, it's more of the same.
Okay, great. And Beck, it feels as if I keep on asking you these compound questions, and I'm going to do the same as well. Again, because I've already alluded to the fact that the space is continuing to grow and evolve. Are there themes or opportunities that are emerging that are currently probably less known that you are seeing compelling risk-adjusted spreads or opportunities today?
Okay, so the first thing, let me preface it with, which I mean, we all know, right? The environment because of tariffs is reshaping the landscape, not just in traditional markets, but also in private markets. And I think it's important to bring in that, that means that there are going to be both, opportunities, but also risks, right? Because obviously what it's doing is creating a little bit more volatility. And, you're sort of going to face these sort of crosswinds really in that near term due to these sort of like either tariff-driven cost pressures or some of the supply chain instability. That said, though, when we look at some of the sort of areas that we like at the market in the market, asset-backed finance is an area where we see opportunities. I mean, Nehemiah touched on it around the fact that, banks have withdrawn from this type of sort of commercial lending. The sort of core middle market, is where we also sort of see that potential for some structural opportunity. It's interesting. A lot of the very large managers are being a lot more competitive, particularly in their trade credit markets. But it's also interesting in the sense that it's the large managers that are seeing, I guess, the greatest degree of competition coming into their arena because of the growth in private credit overall. That actually presents an opportunity when, I mean, we touched on it before when we talk about the terms and conditions, because we are expecting to see as a result of that some of the fees come down in some of these arenas where a lot of the large managers have typically dominated, and have obviously had a lot of pricing power. So it's this sort of push pull that's happening as the environment's changing, both at a macro landscape, but also from a growth and opportunity set. Again, it's, that volatility, that change creates both opportunities, but it does create risks, right? So it's, and I'd echo Adam's point that he mentioned, what do we expect from the performance of the portfolio? Underneath the hood, do we expect like more defaults? Yes, right? There will be more defaults. Do we think that that will impact the total portfolio? No, because the way the total portfolio is built together is that, we've got some of those sort of higher returning, longer lockup sort of investments, but then we've also got some of the much more liquid, shorter term investments in there. And all of them, I would say, a lot of its attention is spent on the fact that we can see that even if the macro environment's going to be a little bit more volatile, a little bit more stressed, you're playing with managers that have a long history of being able to, sort of restructure the finance so that they get the best deal out of it, right? So yes, you're going to see a lot of sub activity, you're going to see a lot of headline news, but the whole reason that this portfolio is built with the number of investments that it does across the different types of investment profiles, is so that a lot of that noise is dampened down, right? And the total solution that the investor is going to see is going to be a pretty consistent ride to where we've already been.
Okay, another very comprehensive answer. And Adam, given Rebecca's comments about changing macro and evolving opportunities, I made note of those two words. Can you talk about our portfolio construction and manager lineup? Are we responding to those changes in the environment?
Yeah, so look, if we look at the portfolio today, it's very stable and it's well structured. As I mentioned earlier, we're now invested in 24 funds with exposure to almost 4,000 underlying loans now. And that's with geographic diversification across the US and Europe, and strategic diversification across direct lending, structured credit, specialty finance, and credit opportunities. We're seeing that our managers are performing well, and they're delivering on their target returns. And we're really not seeing any signs of deterioration in credit quality despite all this recent market turmoil. So going forward, when we look at adding new funds, that really becomes a tactical decision. So every time we consider a new fund for inclusion in the portfolio, we make sure that it'll either increase our geographic or strategic diversification, or preferably both. It'll reduce correlation, and it'll improve the portfolio's resilience. So we're always asking those questions, and we're not just adding funds for the sake of adding funds. And also, a large chunk of our portfolio is allocated to closed-end funds. So we're always working with Mercer to model our forward cash flow profile, and decide on the size and timing of any new fund commitments we need to make sure we maintain a stable NAV profile over time.
Okay, thank you. Audience questions are coming in thick and fast, so I may now abandon my list of questions and just ask the questions that the people who've dialed in want to hear. And the first question, which I think I may address to you, Nehemiah, is if banks have withdrawn from the market, does this mean that it's generally a less safe area to play? Maybe you can talk through the rationale for the banks withdrawing from the segment of the market in which we play.
Yeah, sure. And it's a good question because I think it can be sometimes when you're in a market like Australia where, we have, in particular, our big four banks that account for sort of 90% of all credit, um, um, whether it be through non-bank providing financing to non-bank lenders or bilateral loans to companies or to individuals. When you have that and you have the regulatory environment we have and the way that it's implemented through cycles, it's a real, it seems your first reaction would be, well, it doesn't make any sense that offshore, to this question, that offshore people are, that the banks would be withdrawing from things that actually are good business. Now, what I would say is that if you go back to the GFC, one of the big issues and what actually caused a different type of regulatory response, and it's something that we didn't see in Australia, what I'm about to say, which is that when the GFC happened, it actually was both a liquidity crisis and a credit crisis in residential mortgages. Okay, that created issues in the banking system. And at that time, you had a lot of commercial loans on the books. So decent companies sitting on a bank balance sheet. They were not impaired. They were actually performing, but they were illiquid. You couldn't monetize them when depositors were trying to pull their money out of the bank, okay, as an example. And so with that, subsequent to the GFC, the regulators in the US and Europe wanted to put protections in the system to, in effect, disincent banks from, taking, short-term deposits and making longer-term illiquid loans to companies. And that was when private credit was born. So what then ended up happening is banks have become more recyclers of capital. So they will arrange loans and they'll distribute them. They won't typically hold, certain classes, certain types of assets on balance sheet. And private credit firms funded by institutional investors who had longer term capital created the vehicles through which big segments of the market that used to be serviced by the banks. When I say serviced, I'm talking about bilateral loans on a 3, 5, 7-year term basis, right? That actually really went to the private credit firms. So the banks like to hold the relationships. They want to hold your transaction account. They want to make the fee income, but they don't want to hold the long-term asset because of that mismatch. And it costs them a lot to do that because the regulators have put in place mechanisms that make it very costly. Like you have to hold more capital per loan, per the loan that is extended to, a mid-market company. So as a result of that, all that said, what you then have in the private credit sector is a lot of, great underlying companies, very defensive, non-cyclical in nature, who need financing, and they get that from private credit on a bilateral basis. The banks really just want to recycle capital. They don't really want to hold these loans to maturity. And I'll make one final point because it's very important as well, which is when you go back to the GFC, a lot of these issues actually in the residential mortgage market came down to moral hazard. I could underwrite and sell something to another investor, right? And I got paid a fee. Now, in private credit, what happens with your managers, they're very aligned to investors, right? You invest in a fund, that manager holds that loan to maturity. Hence why they are so selective around who they lend to. Defensive companies, market leading, high cash conversion, very predictable revenue, low capital intensity, all of these things that if you were going to lend your money on a 3, 5, 7-year basis, and you have to get paid back at the end, the kinds of things that you would do in order to ensure that you get paid back, right? So the origination and then how they're managed and the workout resources we've talked about before. So I just thought I'd point that out. It's not just about really good companies. It's about really good management, and it's about really good alignment between, the manager, the company, and investors.
I think that point about incentives is absolutely critical and needs to be made. Next question is, I'm just working out who I should ask this, but Adam, maybe I'll ask you. What happens to returns if interest rates drop?
Yeah, sure. I get this question a lot. And luckily we've got a lot of useful historical data on how lower rates flow through to economies, to corporates and ultimately to returns from our managers. So what we see is when rates fall, as you'd expect, it generally helps to boost economic growth, and that leads to stronger corporate balance sheets and therefore for us more lending opportunities. Obviously, on the flip side, lower rates means lower returns for savers with bank deposits, where the rates are often directly linked to the base rate. So for the corporate borrowers in our funds, we tend to see wider spreads when rates fall, which means higher returns. And that's because the spreads that they're willing or able to pay increases, because from their point of view and from a cash flow point of view, they're mainly concerned with their total coupon. Their balance sheets also benefit from lower cost of debt. So we generally see an uplift in company valuations, which then flows through to higher returns on our loans that include some upside participation. So overall, while we might see a small decrease in the overall returns from our funds, the impact is relatively limited, and it's offset a lot by those factors. A good example of that recently is in Europe, where we've seen the base rate fall from about 3.9% a year ago to about 1.9% today. So it's less than half of what it was. And we really haven't seen a material change in returns or distributions from our European managers. And that's the same experience we've seen over previous falling rate cycles with our managers. So that really gives us confidence that we can continue to meet or beat our target yield even through lower rate environments.
Okay, and a somewhat related question is a lot of the NTA growth from discount reversion in the closed-end funds? Can I assume most of these funds are listed? The person also wants to know. So maybe you can just talk a little bit about how we see the NTA growing within the portfolio, and maybe just touch on the kind of funds that we allocate to, because they definitely aren't listed.
Yeah, sure. So yes, you're right. Almost none of our funds are listed. So a large portion of our portfolio is in those direct lending funds, and that really underpins the cash yield that we're looking to pay. So those are direct lending corporate loans, senior secured. They pay most of their returns in income. So they are and they are at the more liquid end of the portfolio. At the other end of the portfolio, which has a much smaller allocation, is our exposure to closed-end funds. So those are more things like specialty finance, structured credit, credit opportunity type funds. Less liquid, so they have more time for their thesis to grow, and therefore they tend to be focused more on NAV accumulation and less on distributions. So yes, a lot of the NAV accumulation growth comes from those funds, but no, they're not listed. And the other thing I'd add is we focus a lot on diversification of strategy across those funds to make sure they have less underlying loans. So we want to diversify more across managers and across strategies.
Okay, Beck, I think this next question fits firmly into your field of expertise. I would hold this investment in the segment of my clients' portfolios that can't lose money. So I primarily allocate to fixed deposits. Pengana isn't a bank. How do I explain this to my clients?
Okay, so where do we position private credit? We absolutely do put it in the defensive part of the portfolio. I probably wouldn't go into the absolute can't lose money camp. We don't, at the moment you're investing, we don't put anyone in that don't lose money camp, because as we've all seen, any form of investing, whether it be fixed interest, whether it be equities, you can still lose capital at any given point in the cycle. Doesn't mean that you won't necessarily get it back. But you can, at any sort of point in that market cycle, be sitting on an outright loss. But why do we put it in the defensive part of the portfolio? I think what you've heard about the guys talk about today a lot is the yield, the income, the terms and conditions that structure it so that you know. So there's a lot of characteristics that resemble what we are used to seeing in traditional fixed interest, right? There's a sort of a known yield that you're going to get. You've got a known term and condition that it's there. So all these things are pretty familiar. The difference, what's interesting about them is that most private credit is what we call floating rate note, right? So, i.e., its yield is moving up and down with where interest rates are, as well as let's just park the terms and conditions. So they have a natural inflation hedge in them, right? Now, Adam's gone through that in quite a bit of depth as to how that works both positively and also negatively. But net, you tend to be in a better position, right? Because it's part of the portfolio that you don't sort of have to worry about. The other area that we really like the private debt for is that consistency of yield, right? Because when you've got retirees or retirement type portfolios that need an income that is paying out of it, that is not depleting it from the capital base, this is where private debt really comes in, I guess, into a sense, into its own, right? And, again, it's not all private credit is made equal. This is one of the reasons why this is a very broadly diversified portfolio, right? If you went into one section of our portfolio that is, sort of that much more, sort of what we would call higher octane debt, and that was all you were investing in, it's probably, I wouldn't put that in the pure defensive camp, right? But because we've built it as a diversified portfolio with that consistency of yield, with that focus on capital preservation, this is how we treat it in portfolios. But I will always state, the moment you are investing, you have to be prepared at some point for a degree of capital loss.
And what do you see as I'm just going back to find this, make sure I get the time frame right. What do you see as the biggest risk that could hinder performance over the next 12 to 24 months?
Yeah, it's interesting. I mean, we're studying it all the time, right, in terms of what's there. The biggest risk ultimately is I just think the degree of volatility that's out there in the markets. And I think, that risk is resounding all the way through, whether it be public or private markets. I'd hazard a guess, though, that, private markets have a better ability to navigate this, in the sense that they have an ability to structure their terms and conditions better than just always at the whim of sort of the public market arena. But, the reality of it is that, the environment is changing, right? We're seeing, supply chains being broken down. That creates instability. We're seeing sort of those sort of cost pressures come into the equation. We've still got technology issues that are there. But typically deal structures in private markets are better equipped at handling these changes than sort of public markets, but they still remain a risk, right? You still got to ensure that you're focused on those strategies where they're trying to decrease exposure, to sectors where they think risks are increasing, and that they're ahead of the curve, right? So if you look at, some of the opportunities that we're seeing, Europe is tending to look a better place to invest than the US, right, at the moment. And that's just the nature of that sort of macro sort of environment, as well as also the emergences and developments that are going on in private markets. So it's probably not the easiest question to answer. I think, Trump and the tariffs and the geopolitical changing nature of the world that we're operating in are ultimately the biggest risks on the equation, right? The most manageable risks are the ability to manage structures and deals to, be able to recoup any losses that are emerging or restructure deals. That they're the knowns that we've got with managers, right? That's where the track record is, the long history. The unknowns are sort of that sort of macro environment that we're heading into.
So in the environment that you've spoken about, diversification is absolutely our friend. And I'm just going to remind everybody that we have 24 underlying funds, very diversified strategies, over 3,000 underlying loans. So I think that is the best mitigant we could have against many of the risks that Rebecca described.
Sorry, Adam, I'd add one more thing there. So when we talk to our managers, what we see is they've all got very long track records over time. And, they've all been through Trump 1.0. They all went through the election process. They've seen tariffs, maybe not to this extent, but they've certainly seen tariffs, and their underwriting process very much takes account of that worst case scenario. What happens if this all happens again? What happens if it's worse? So they go into this in the best possible situation. Can you foresee every situation? No, but they really go into it with their best foot forward to really try and manage good outcomes.
Thank you. Beck, I actually thought you did a good job of describing the value of global diversification, but this person clearly didn't agree. So Nehemiah, maybe I'll give you a chance. Compared to what's happening in the rest of the world, Australia seems like a pretty good place to invest, and I'm making healthy RBA plus returns. I hear the pitch, but is it really necessary?
Look, I'd say, I'm a big believer in diversification, right? So, but my starting point would be, how any Australian investor, can think that it's unnecessary to diversify. And just when I think about, long history in banking and kind of having gone through GFC, both from a domestic and international perspective, and that's because, firstly, Australia is not immune to global, right? We, as an economy, rely on US dollar and euro dollar debt financing, right, to finance the gap that we have in savings. Okay, and that typically sits on the bank balance sheet. But as a country, we are, very long US and euro dollar debt. And that's in an environment where we have very large government debt and growing physical deficits. And we don't have, as far as I'm concerned anyways, any structural initiatives in place. Now, maybe coming out of the tax reform stuff that's coming, that whole form might come up with structural things, but we have no structural initiatives in place that would change that position. Okay, and that's a precarious position to be in when you're actually long foreign liabilities to fund, to fund the economy. So I look at that and say, okay, that's one. Number two, Australia is concentrated in industries, and our local investments are quite correlated, right, to the macro things, which is what I talked about at the outset. So if I look at that and say compare that with U.S. and European markets, are very large markets, where there remain very significant structural opportunities that lack capital in the banking system to pursue. Okay, so if you're pointed at those things on a longer term basis in large markets, and the fact that we're pointed to the managers who kind of face into those opportunities, and the fact that we lend on a senior secured, basis to businesses that have a real reason to be, and that we're really widely diversified within that context. I'd argue that it is a must for investors to be looking at diversifying into global private credit, just like you would in every asset class that you're in, right? Everyone's diversified, whether it's equities or any other asset class. And I'd say we have, at the moment, we've got the only diversified vehicle that's available to do so at an institutional quality, given our Mercer relationship. So to me, the first thing is I wouldn't be just in Australia for the reasons articulated. I think it's worth looking at looking offshore at appropriate ways to enhance your diversification, lower your correlation, because we are not structurally immune in this country to what is happening in the macro. And so I would urge every investor to kind of at least have a look and see what's appropriate for your risk appetite as well as your liquidity requirements.
Right.
Adam, if you're happy, I might just jump
Yeah,
in
go.
because it's quite interesting. The Australian, and we've touched on this before, right? The Australian private debt industry is largely dominated by real estate financing, and it's interesting that the opportunity set that even things like the think tanks like the Investment Council of Australia and others are looking at is really starting to be in that energy transition space, right? Which is something that Australia could lead the world in. The challenge then would become is do Australian private debt managers, and let's be clear, we actually really do like some of the Australian private debt managers. I know this product doesn't hold them, right? But, you know, but there are some very good quality managers out there. But the challenge would then become that if our market is going to become more broad, right, and more diverse and give us some of that diversification, do the managers that are here currently have a background in that? And that may be a challenge in itself, right? Or will some of the more global players start to come into the Australian marketplace and be offering, in that sort of arena? I mean, I don't have the answers to that, but that's where you want, expertise and background. So it's. I mean, I think Nehemiah, what you're really sort of saying, I always look at it is if you want to play in Australian private debt, you're predominantly playing in real estate finance. That's what you're predominantly playing in, right? I don't know many people that would just play that in their equity portfolio, right? They would go, no, I think I need more industries, more sectors, and that's really the challenge, right? That you're faced with here.
Yeah, totally agree.
And I'm not going to remind everyone about the diversification again. There is a question here which I think I will take. The market cap of the portfolio has been stable around 170 million. Is this the max capacity of the fund? If not, what are the plans to grow it? So I'm just going to respond to that question and say there is, from a private credit perspective, a global private credit perspective, there is currently plenty of unmet demand for loans. It's a growing sector. It's highly scalable. And if you think about the Pengana innovation, which we brought to the market when we listed PCX, that we have this quarterly buyback to support NAV stability. And so every quarter we tender for up to 5% of the units on issue. Now, if we are just buying back units, then we are not creating a sustainable vehicle in any way. So yes, our intention is to grow the vehicle, and we will be coming back to market at some stage in the future with an offer to ensure that we are able to meet the unmet demand for units. We've seen the unit prices spent a fair amount of time trading at a premium. We absolutely do not want to do anything to change it, but there are a lot of investors out there who say, well, we don't want to start advisors who say we don't want to start allocating because there isn't enough liquidity on screen for us to get set for all of our clients. So there is the interest in additional, acquiring additional units, and we will come back to market at some stage to raise more capital there. Just Adam, briefly re-explain, please, the process of NAV accretion. Keep it short and sweet because we are running out of time, but apparently you didn't do a great job explaining that either.
Yeah, sure. I think you're talking about there's the one question about when you see the NAV accumulation in the closed-end funds. So that happens progressively over time. So what will happen is we'll have an investor in a corporate, and we will see revaluation of those positions in the corporate every quarter, and that will progressively come through as NAV accumulation. The main difference is really it's not being distributed back to investors. It's just being accumulated in the NAV of the fund.
Thank you. We are running out of time. We will get back to all of the listeners who've asked questions and we haven't addressed them. I do apologize for that. Before we close, I thought I'd ask Nehemiah if you have any final comments to make.
Yes, thank you, Adam. I think first and foremost, thank you to everybody for taking time out of your day to join us today, and just leading with a few key thoughts, which at risk of being repetitive. Number one, I'm really pleased that we've been able to perform and deliver what we promised through what have been some pretty interesting and volatile and uncertain sort of macro environment really since we listed. I think secondly, we've done everything that we said we would do. We said we would provide stable income. There would be some accumulation, and that with the benefit of our innovative buyback mechanism, that we would be trading in line with our NAV, or that was the intention. And with the result being that on stable income, we said we're targeting a minimum yield, just distributed yield of 7%. For the vehicle, and in the last 12 months we've delivered just over 7%. Now a reflection of the seasoning of our portfolio when it goes to accumulation is that our total return since inception of PCX, when you include the distributions and the NAV accretion, is 8.4%. And that's allowed us to do two things. It's allowed us to increase our monthly distribution, which we did so in June. We increased it by 10% from 1.17 cents to 1.32 cents. And as Raps talked about earlier, we declared a one-off increased distribution of 3.32 cents per unit in July. That's payable in August, and that's part of that is a 1.32, and the other is we paid an additional 2 cents. Out of that accumulated NAV, right? And when you look at trading in line with our NAV, well, we've had a 67 basis point kind of weighted average premium over the last 12 months of the unit price relative to NAV. So very proud of that. And I think to close, we think the outlook is attractive for us, irrespective of what happens in the external environment, for a lot of the reasons that I covered earlier, and that we're confident that we'll continue to perform on a relative basis, irrespective of what happens. And finally, we really look forward to continuing to deliver that very stable income paid monthly, continue to grow our NAV, and we'll seek opportunities, to make distributions of accumulated NAV over time. And then finally, as you said earlier, Adam, we really want to be growing the PCX vehicle. And so we will take opportunities going forward, to do just that.
Great. Thank you, and thanks to our presenters. I think you did a great job, and thank you to everyone for joining us. I hope that despite the change in format, we gave you a better sense of how we're thinking about the portfolio and our outlook from here. So if you would like to do a deeper dive or discuss how PCX might fit into client portfolios, please get in touch. We'd love to hear from you. Thanks again and enjoy your day.